All right, good morning. Thank you very much for joining us. We're just past 9 o'clock, so I'll be introducing today's discussion, and that might give a little bit more time for others to trickle in. My name is Drew Barnes. I'm head of financial planning here with Traction Financial Partners. I was fortunate enough to join the team here at the start of February of this year. I'm a CFP certified financial planner by background. And I will be speaking a little bit about the financial planning aspects and planning around inflation for today's discussion of understanding inflation in 2022. To wrap up the discussion will be Bob Haycoop, and I'll turn it over to him here briefly to introduce himself.
Good morning. Thank you so much for carving out the time in your day to join us. It's my fault this outfit came together. I started in this business just a little over 20 years ago. And my wife, Virginia, and I split our time between our place in Encampment, Wyoming and Parker, Colorado. And we look forward to having a good discussion today and sharing what we're seeing about all that each of us hears on the news each and every day. And with that, I want to introduce Evan Barnes, who's going to kick off our presentation.
Thank you, Bob, and good morning, everyone. Quick background on myself. I'm co-founder and executive vice president of Traction. Been in the business for 15 years and excited to talk with you this morning about inflation. And obviously inflation is a hot topic this year. Everybody's feeling it and seeing it in their day-to-day lives. So we thought it would be a good idea to walk through how inflation comes about. How do we address inflation from a government standpoint? What does history show us in terms of investing in inflationary environments? And then as Drew and Bob said, Drew will be doing more of how does inflation affect your financial plan? And Bob will go into the more of the business aspect of it for our business owners out there. But we'll jump in and get started. So Katie, if you want to flip to the next page, we'll get rolling. Okay, so inflation in basic terms, inflation is too much money chasing too few goods. And when you look on the screen, you see it's a measure of M2. The M2 money supply is a measure of savings deposit, money market, currency, coins, basically all the money circulating throughout our economy. And as you look at the graph here, this is going back about 5 years, you can see the money supply growing. And then when we hit 2020, pandemic time, the money supply exploded. And so that is the supply side of things of too much money. Okay, and we'll talk about the too few good stuff here in a second. But it's a simple graph here explaining that the money supply has grown by about 40% since 2020, since the pandemic started. This is a huge cause of our inflation that we're seeing now, in conjunction with some of the other things we're about to discuss. Where has the money been spent? How has it been spent? Let's go to the next slide and we can take a look from a government spending perspective or stimulus in conjunction with what the Fed has done. So how do we get all this money into the economy? Since the beginning of the pandemic, the government, in terms of stimulus, has spent about $5 trillion. Okay, and we see that they are likely to pass more government spending here in the near future. But what has been passed and put into the economy, we're looking at $5 trillion in government spending. So on the left-hand side of this page here, you can see kind of how that was broken down. Individuals and families getting close to $2 trillion of the $5 trillion that have been spent. The most common or known aspect of this spending was the unemployment benefits. The economy shuts down in 2020. Many people lose their jobs. And so the government, to help those out who had lost their jobs, unemployment benefits, not only were they extended, but also increased. So between March and July of 2020, there's an extra $600 per week of unemployment benefits for those who had lost their job. On the right-hand side of the government stimulus spending, you see businesses, $1.7 trillion went to businesses. And there's a little arrow at the bottom there. It says roughly 80 billion went to airlines to help pay for pilots, flight attendants, and other staff who were furloughed. As part of the pandemic, obviously people weren't traveling. We couldn't travel. We couldn't go places, spend money. So those in the airline industry, for example, needed some help, and that's where that stimulus went. Another common and well-known part of the business spending from a government stimulus perspective was the PPP loans that small businesses, those who had under 500 employees, were eligible for. It was a free loan, assuming you went played by the rules, but 2.5 times your monthly payroll cost, up to $10 million. Those businesses were able to get some assistance during that time as well. More spending, state and local aid, about $745 billion, healthcare, and then another almost $3 billion in spending just went to other causes. So that was from the stimulus side of things, from Congress passing bills to help during the pandemic, but that is shoving a lot of money into the economy. And one thing that I failed to mention before is that we actually had a good economy coming into 2020. You know, the economy is growing around 3%. Individuals and companies had pretty strong balance sheets at that point. It wasn't a 2008 type of a deal where people were over leveraged and had adjustable rate mortgages that they can't pay, those types of things. Not that people didn't lose their job and need help, but a lot of folks were doing fine or fairly well coming into the pandemic. And then we threw all this extra money in there, but we couldn't spend it. And we're going to talk about that here in a second. So that was the government stimulus side of the spending. Federal Reserve, quantitative easing. What's quantitative easing? So the Federal Reserve, in an attempt to provide liquidity into the economy and help us during that the pandemic lockdown and downturn. The Federal Reserve's balance sheet has ballooned following the pandemic to approximately 8.393 trillion. For reference, February 2020, that number was 4.158. More than double. The balance sheet of the Fed has more than doubled since the beginning of the pandemic. Again, a massive explosion of their balance sheet and the money supply. Again, I just mentioned before, they use this to provide liquidity into the financial system. And how do they do it? They do it by the Treasury prints money, the Fed buys the Treasury securities and government guaranteed mortgage-backed securities, the Fannie Mae, the Freddie Mac, those types of mortgages. So the Federal Reserve is throwing money into the economy by buying those the Treasury securities and mortgage-backed securities. So that's part of the quantitative easing. They also lowered the federal funds rate. So we're going to talk about interest rates here in a little bit, and that's been a hot topic this year. The federal funds rate, when the pandemic hit, the Fed dropped it to basically zero, in the range of 0 to 0.25%, trying to provide liquidity and also, hey, it's easier to get loans, business loans, mortgages, just consumer loans in general. Wanted to encourage that type of activity during the downturn. So when you look at this slide, there's a lot going on here, but when you consider how the money supply has grown by 40% during the pandemic to date, this is a big reason why. All right, next slide, Katie. Thank you. So when you have that much money going into the economy, that's creating a lot of demand. Hey, I have extra money in my bank account, well, want to spend it. So there's the demand to buy goods and services. But the problem is when you don't have the supply of those goods and services. So the supply side factors played an equally troubling role into where we got to the inflation rate we're at now. Supply chain disruptions. We've heard a lot about supply chains. Obviously, COVID was the primary driver of supply chain disruptions. I mean, we shut down global economies. Okay, we have a very global economy and marketplace where we get a lot of our goods and services from across the globe. And when you lock down and close down the world, you're going to have supply chain disruptions. So COVID-19, the lockdowns, and then you have, for example, a supply chain disruption in oil and gas. You got Ukraine-Russia conflict, global bottlenecks. When you think of, you may have seen the news stories of cargo ships off the coast of Long Beach and LA just packed out there because they didn't have the people to unpack the ships. We didn't have the ability to get those goods to where they needed to go. So there was global bottlenecks, equipment availability, and then labor shortages. So another key factor on the supply side of things is that when you have labor shortages, you go out to a restaurant, it takes, you'll see that they don't have the staff to do it, or there's issues with being able just to hire people back that left during the downturn because they went to different industries or they just haven't come back to the workforce. The labor force participation rate is still lower today than it was before the pandemic. So while we have a low unemployment rate, which is great, a lot of people still haven't come back to the labor force. So we kind of have this good news, bad news thing when you look at the labor force and the economy. It's like the great to have a low unemployment rate, but we don't have people coming back to fill open positions. For example, in July, there were 528,000 jobs added in July, which was a huge number, basically double the estimate. But when you look inside those numbers, over 300,000 of those jobs are part-time jobs. A little bit less than 100,000 of those jobs were people who have multiple jobs. So as we have inflation in the economy, people need extra money. It's, hey, let's go get a part-time job or add another job. So that is a little bit misleading in terms of how many jobs we're adding, because we still have plenty of openings and more people need to come back to the labor force to be able to help with the supply side disruption that we've been seeing. Another thing that's been in the news recently is chips, right? So we have chips go into basically everything we use these days, but in particular, you hear a lot about cars and those types of things. Taiwan conflict potentially with China, that could be an issue because Taiwan has the largest chip manufacturing company in the world. So those geopolitical events also add uncertainty to the global marketplace, just as Ukraine and Russia have. So we've covered how much money went into the economy, creating demand, and then we have the supply side of things that just hasn't caught up yet. Thus, the inflation has picked up to the level that it's at today. Next slide, Katie. The CPI's Consumer Price Index is the measurement of inflation on the consumer side of things. 8.5%. This was good timing because as of yesterday, the new CPI report came out for July. And so year over year is the number that they'll report, 8.5% inflation from July to July. Obviously a big number. It did come down from where we were at the prior month, which was 9.1%. So we did see inflation not grow in July, but how do we still have 8.5% inflation? Is of food, groceries, rent, that type of stuff still increased. The core inflation numbers still increased in July. We got a little bit of reprieve on the energy side of things, as you saw probably as you went and filled up your tank. That gas prices have pulled back, still at a really high level, but have pulled back from the all-time highs we were seeing in June. But this is a good slide, and if you just went to that website there at the bottom, there's a lot of charts, a lot of things you can kind of poke through to get even deeper into the CPI components. But this does a good job of kind of encapsulating everything. Energy up 33% year over year. You look at on the right hand side, you can see new vehicles up 10%. Airfare at the bottom right hand corner up almost 28%. So just across the board, a lot of what we consume, a lot of services we use continue to go up, especially year over year. Next slide, Katie. Okay, so how do we fix it? How do we combat inflation and have it turn around the other way? So how do governments do it in particular? Really, there's three different approaches. First one being increasing the federal funds rate. Okay, so we just talked about in 2020 how the Fed dropped the federal funds rate to zero. When you that again creates a lot of activity in the economy. It's easier to get loans and those types of things. Well, one way to slow the economy down is to increase interest rates. And we've seen that happen this year. This encourages, or it effectively slows down the economy, encourages banks and other lenders to raise rates on consumer and business loans. Currently, as of a couple of weeks ago, the federal funds rate is between 2.25%, or 2.25% and 2.5%. Remember, that was zero at the beginning of the year. So they've aggressively increased interest rates. The forecast about how they're going to end the year with the federal funds rate is kind of constantly changing. Right now, the market is betting that the federal funds rate is going to be somewhere between 3.25% and 3.5% by the end of the year. Obviously, a big jump from where we were to start the year. Many would argue that that's not fast enough. But the Federal Reserve kind of has that balancing act to try to do that soft landing, is what they keep saying, where they're trying to slow the economy down without really kind of going recession or even worse. Case scenario, I think it's a pretty tough job that they have to do. Don't feel totally bad for them, because I think that they played a big role in where we're at. But that's what the Fed's trying to do, is trying to say, okay, let's slow the economy down to bring down inflation, but not throw us into too bad of an economic environment. Part of what the Fed can do is raise interest rates. The other part is quantitative tightening. So we discussed quantitative easing when they were buying Treasury securities and mortgage-backed securities to try to flood the market with more cash and liquidity. The reverse of that now is, hey, they have that big balance sheet. They need to try to unwind it. So starting in June, the Fed's plan was to allow 30 billion of Treasury securities and 17.5 billion of mortgage-backed securities to roll off the balance sheets every month. So they're going to let those mature and roll off the balance sheet, not purchase anymore, trying to reduce the size of that, take money out of the economy. That's really the best way that the Federal Reserve can, in my opinion, attack this. Obviously, interest rates is a key rule, but reducing the money supply, reducing the size of their balance sheet is going to be key. And the last one on here is price controls. It doesn't sound like that's something that is going to be implemented. We've heard it suggested, but price controls historically have really not been the best tool. When you implement price controls, you tend to get less of something, right? You're going to potentially have favoritism about what areas of the economy are going to have price controls on them. A lot of times when you put price controls on a particular good or service, you get less of that or lower quality. Think of rent control, right? Where you can't increase rents. You may not have the money to fix up your rental building. That quality may not just be as high as it could be if you could be raising rents. So that's an example of price controls, but they are doing the first two, increasing the federal funds rate and quantitative tightening. Next slide, Katie. All right, historically, from an investing perspective, what has done well during inflationary times? Okay, so on the left-hand side there, you can see high inflation and what historically, and that's a more than 5% inflation, which we're in now. So historically, what's done best, and that's commodities. Okay, when you think of gold and you think of energy and precious metals and those types of things, historically commodities have done best. A lot of times when you have high inflation, your purchasing power is going down. The dollar could potentially be weakening. So people will usually flood to commodities, right? Something physical, something tangible, those types of things. Left-hand side, you can see U.S. equities and non-U.S. equities. So stocks have done well during inflationary times. To the right of commodities, you see REITs, real estate investment trust. Real estate values tend to go up during inflationary times. Rents tend to go up during inflationary times. So real estate investment trust could be a good investment from an income perspective and also a value standpoint. One thing on here I wanted to point out, we're in a little bit different environment now than we have been in the past during high inflationary times is bonds. So historically, it's showing bonds at 8.4%. Okay, that's not happening right now. When you go back into the 70s and early 80s, bond interest rates were in the teens and potentially a little bit higher. And then as interest rates dropped, that's the old teeter-totter effect. Interest rates go down, price of bonds go up. So bonds have done pretty well historically during inflationary times because interest rates were already so high to begin with. And then once they start coming down, the price of bonds go up. We're in the opposite of that currently. Bonds have really struggled this year because as interest rates have gone up during this inflationary period, bonds have struggled. So interest rates go up, price of bonds go down. They've started to stabilize. At one point, the aggregate bond index for the year was down 10% in 2022. So it's been a rough year on the bond side of things. Commodities have done well. Equities, in terms of stocks, obviously have struggled this year. But over July and so far in August seem to have started their recovery. But this is a good snapshot of kind of what has done what historically from an investing standpoint. Next slide, please. All right. The most important thing is maintaining a long-term focus. Okay, when it comes to investing in inflationary times, if you're in a position where, hey, I'm taking income off of my portfolio, or hey, I have a lump sum of money that I'm going to need to take out to buy a house in a couple of months, there's different strategies for those. All right, so this is long-term money, retirement money, those types of things. Make sure we have a long-term focus. That historically equities, right, stocks have outperformed. We just looked at the charts there. Equities, REITs, commodities, treasury, inflation protected securities, those types of holdings have done well historically during inflationary times. Structured products is something that folks on this call may be familiar with, that we use in Traction as a supplement for bonds, and that's worked out well so far. So there's different strategies that we use for different risk tolerances, for different goals and objectives. But the most important thing is that we maintain a long-term focus, that we have a goal, that we have a strategy in place during these inflationary times. And the last piece on here is to consider going through and implementing a comprehensive financial plan. That's something that Drew's going to cover here and go through in terms of how does inflation affect your financial plan. So I'll let him take it, and it's all yours, Drew.
Thank you very much, Evan. That was really great information on kind of what's caused inflation, what are some of the tools we can use to try to combat that, and what assets have returned in those types of environments in the past. Before I get into my section, I failed to mention on the front end, we will have a Q&A at the end of this. If you look at the top of your screen, kind of where all the various settings and options are, you should see a Q&A logo, if you will, and then you can submit questions there, and we'll get to those at the end. All right, so the impact of inflation on your retirement, it's really the hidden risk to everyone. You know, there's risks that we can control, you know, in terms of how much risk are we taking on in the portfolio, how much are we spending, and there's some risks that we cannot control. What is the market going to do, and how hot may inflation run? So when we talk about retirement planning, particularly with inflation in mind, I think it's really important to kind of reframe what we identify as risk. Most people want to protect their money, if you will, and that's very reasonable. However, you maybe need to have a little more nuanced thought process in terms of what that actually means. If you want to stuff the money under the mattress, sure, that money is not going down if there's any kind of stock market declines, but you are essentially locking in losses to inflation. So, your dollar that's a unit of currency. You can protect your unit of currency, or you can protect your money, and that means you need to have it managed in a way that you're keeping pace with inflation. So inflation, which we'll look at here on the next slide, is really the biggest risk to most retirees, and it's kind of an afterthought. I know it's probably not right now with how hot inflation's been running, but it's certainly not something you can ever discount. So financial planning is going to go a long way to ensuring that you are prepared for retirement, and if inflation hits like it is now, are we positioned to be able to weather that storm, or are there any kind of adjustments that need to be made to your personal financial plan? And there's a handful of ways that you can do that. You can reposition your portfolio. Generally speaking, if inflation is going to be a big risk for you, that may mean you need to be willing to take on a little more investment risk, which means having a higher percentage of the portfolio in equities. That doesn't mean you need to be speculative or anything like that, but high quality stocks, diversified, that have been proven over the long term to not only keep pace with inflation, but meaningfully outpace inflation. And as Evan mentioned in his section, historically bonds have given you 8%. We just haven't lived in that world for quite a while now. I was just looking this morning, the 10-year treasury yield is at about 2.85%. That's climbed from 1.5% to start the year. So it may not seem like a very big jump, 1.5% to 2.85%. It did reach 3.4% at its height this year. But when interest rates double like that, it really leads to major price declines. And as Evan mentioned, bonds were down north of 10% at one point this year. And we don't have that high income, the high interest rates to offset those losses of principal. And while we've certainly made a big move in interest rates this year, 2.85% is still very low from a historical standpoint. I mean, we're looking at 4.5% or so as the long-term average of a 10-year treasury yield. So where I'm getting to with that is to protect your wealth against inflation, especially for a liquid portfolio. Stocks are essentially the only game in town. Now, that doesn't mean that we need to completely abandon all risk management and get out of bonds or anything like that, but we have to generally be willing to accept a little more investment risk to meet our goals. And the way we do that is with equities. You can move to the next slide, Katie. Thank you. So what we're looking at here is just kind of some general assumptions of a sample financial plan that we put together for today's presentation to really show you what the impact of inflation can look like. And it's always unique to everyone's individual situation. So, you may be in a different situation than this, but it's a very useful exercise to run through. So if we just kind of look at the general assumptions here, we've got Ted and Nancy. They both just retired at 65, and we expect them to live for 30 years till age 95. Assets, they have 50,000 in savings, 250,000 apiece in IRAs, 200,000 in a joint investment account. So, 700,000 in investments, 750,000 if you include savings in liquid assets, and then their home's valued around 450,000, and it's free and clear. However, when we're in retirement, the home value, there's ways to leverage that, but generally day to day, that doesn't help us if we're trying to meet expenses. Income wise, they're both going to be receiving 30,000 a year in Social Security. And if you look directly right at that there at the bottom, we're assuming 1.81% in annual cost of living adjustments for that. And that's low. Last year was certainly much higher. It was 5.9%, somewhere around there. But that is the historical average. So that is what we work with, certainly to be a little more conservative. And then to the top right of the assumptions, we are using a 3% inflation rate. I know that's far lower than what we've been experiencing really the last 12 months or so. But prior to that, we had inflation running maybe at 2% for north of a decade. So again, over the long term, we're looking at a 30-year picture here. 3% has essentially been the 50, 60-year average, which does include the last time we saw inflation like this back in the 70s and early 80s. They are going to be spending $70,000 a year. That is, out of pocket or after tax expenses. And just to kind of ingrain what inflation means, 20 years from now at a 3% inflation rate, that 70,000 is north of 126,000. At 4%, it's north of 153,000. 30 years from now, 170,000 at 3%. And then at 4%, 227,000. So more than triple if we get 4% annual inflation 30 years from now. So that's why we need to really, and 4% is a relatively high inflation figure, but it's not a number that's going to necessarily blow any of us away. So that's why it's always that hidden risk. Do we have everything positioned today to be able to meet the needs of $227,000 a year in annual expenses towards the end of our life? And Ted and Nancy here, from an assumed annual return, they're very conservative folks. They don't like a lot of stock market risk, so they have very little of their portfolio in the stock market. They're earning about 3.68% per year on those accounts. Again, their goal is to retain and preserve the principal of what they worked so hard for to save. So they're not, at this point, willing to take on that investment risk. So we're good to go to the next page, and let's look at what the results would be in this scenario. So on the left, if you look at it kind of in 4 different columns, what we use from a financial planning software runs what's called the Monte Carlo simulation. So it takes all the inputs we just looked at, and it runs 1,000 different trials. Really, really poor market returns to really, really high market returns, everything in between. So when we're doing financial planning for clients and we see a year like we've seen this year, we're accounting for these variabilities within the plan when we're running it through the software. It's going to account for 2008 type of scenarios, and not just once, but multiple times throughout the course of a plan when we're looking at 1,000 different trials. So if the plan numbers are looking good, we say, hey, this is something we've planned for, something we expect to happen probably a few more times throughout the course of your retirement. So it kind of helps bring a lot more security and let you feel a lot better, even if we're in market declines, to really do what's prudent. And what we know is we don't want to sell low. But if we look at just the base facts that we went through at 3% inflation, it runs 1,000 different trials, and 98% of the time they succeed. We get to present a 98% success rate to a client. We're feeling awfully good about that. But again, these folks have a very conservative portfolio. And as we showed, their retirement income, which starts out covering the bulk of their expenses, they had $30,000 a piece in Social Security, but it's only inflating at 1.8%. So over time, their income stream is growing, but it's not meeting the rate of even a 3% inflation. So their portfolio is enough to make up the gap if we're seeing 3% inflation. Here's what's pretty mind-blowing. If you look at the next column over, we just increased the inflation rate from 3 to 4%. 0% Monte Carlo result. So 0 out of the 1,000 different trials did they make it and not run out of money by their ages 95. That's a pretty drastic dispersion of results there. And this is why we are so, it's so ingrained in our philosophy to be invested in the equity markets, because they are what's going to help us keep pace and outpace inflation, hopefully. So when inflation moves to 4%, they're not even making that per year in their investment returns. So as that builds and builds and builds, their assets simply aren't enough to keep pace with that. So as I mentioned on the a couple slides prior, there's a handful of ways that we can handle this. If inflation's running at 4%, and you're not going to make it from a planning perspective, well, we know that one of the ways is repositioning the portfolio. So that we in this case, take their 3.68% return. We reposition the portfolio to where we now have about 60 to 70% in stocks. We kind of consider that to be the sweet spot for most retirees. It's obviously unique to everybody. So the return's now a little north of 7% annually, and just like that, 84% on the Monte Carlo results. So we're very pleased with that. And then just to throw in another example, let's say they're like, okay, we're not quite comfortable going all the way up to 60 to 70% in stocks. What if we, went to 50, 55%? So then their rate of return's only at 6.24% a year, taking on a little less investment risk. But if they just delay retirement by a couple of years, 87%. So very strong still. We're comfortable in that 70 to 75% range. Now, that's not always an answer that people want to hear, is that they maybe have to work a couple extra years. But boy, is it good to know that if that's something that is necessary, rather than running out of money later on in life. So just a couple of examples here to show you the impact inflation has on retirees, how important it is to try to maintain your purchasing power. Hopefully we grow it over time by outpacing inflation with returns on the portfolio, and then some of the other ways that we can tweak a plan to make sure that we succeed if we see higher than normal inflation. And 4% over a 30-year period, I know it probably doesn't feel like it given today's rate of inflation. That's a pretty high rate of inflation though. So those are a few of the things that we can do to combat inflation, but it's so important to plan around it. And that's why we're here to help clients do that. So that is the end of my section. I'm going to pass it off to Bob, and Bob is going to speak about the impact to businesses that inflation has, and then we'll kick off the Q&A section.
Thank you so much, Evan and Drew, for your hard work and your research, and for Katie putting this presentation together. Just going to speak briefly to those of you that are business owners. We know a number of you either own a business today, or you've owned one in the past, or you work for one. And we all know that entrepreneurs and small businesses are the backbone of America. They're the backbone of our economy. They fuel innovation, they increase opportunity, and they drive job creation. And we're all about creating jobs. Thinking about a business, and many of you already know this, but I have deep roots in entrepreneurship. A great-grandfather, a grandfather, two uncles, my dad and my brother, and myself have all been business owners. And we've had to figure out and fight how to make payroll. We've had to live through times of recession. We've had to live through times of our business changing, how we do business changing. You can only imagine when we had rotary dial phones that we had to answer to have business, rather than people being able to email us, text us, respond on social media or our website. So let's just talk briefly about how inflation could be impacting your business. First of all, inventory. We know that raw materials that go into products that are manufactured, those have increased simply because of what we've seen over the last 2 years with the pandemic. Being able to ship, Evan alluded to it earlier, all those barges sitting there with billions of dollars of goods waiting to be unloaded that nobody can use, nobody can access, because there's just not enough people to unload those ships. So being able to get things shipped and fulfilled is just critical to being able to be successful in our businesses. Labor, we've all experienced this. We've seen very large signing bonuses to come in at a very entry-level position at McDonald's, to come in and learn the fast food business and be on a team, whether it's at Chick-fil-A or McDonald's or Burger King, Chipotle, whatever it might be. The cost to be able to find those employees has increased, and the cost to be able to pay them a living wage and one that will get them off the couch has also substantially increased. Starting a business, go ahead, Katie. Starting a business in these kinds of times, there are so many things that we need to look at. Continuing to have a successful business that's been in business for maybe decades is critical. As we jump in and talk about the danger of not increasing your prices, which really flows right into what we've been talking about with inflation, we'll go through a little case study here. In a Bloomberg article that was written, it'll be 2 years ago, Saturday, I think it was, 80,000 businesses just from March 1st of 2020 to the end of July, 80,000 businesses had to close their doors. Most of those were in the service sector. So the restaurants, the hospitality business, whatever it might be, they just did not have the capital and they were completely shut down. Many of them have come back. Some will never come back, but the ones that have learned a very powerful lesson about being aware of your customer and increasing prices when it's appropriate. So this little example I'd love to share with you. Let's say you had a 10% net income in your business. Your 40% cost of goods sold as a share of your gross revenue. Let's say your cost of goods sold, because getting that raw material or whatever you resell into the business went up just by 10%. Now your cost of goods sold is 44%, and your net income has dropped to 6%. If we use an example of just $100,000 revenue on a monthly basis, that's a decrease in net income to $6,000. I don't know about how many people that are on today, but many I've talked to can't afford a 40% drop in their income, especially as we're seeing this crazy inflation here over the last 12 months. So the question is, and this is a good question for today, it's a good question for when we're in better economic times, is what were you doing with that extra $4,000 a month when you had it? Okay, Katie? Whether you're struggling today because of what we've seen happen in our economy, in our country, and the world the last 2 years, or you want to be better prepared. Next time we go into this, Evan spoke to this earlier, many businesses, many individuals and families were doing pretty well going into the pandemic. But we should always be analyzing our business and understanding these costs and how it impacts us. So 6 key things that we should look at with business, and sit down with your well-qualified CPA and get an understanding as you sit there with your leadership team, really evaluate your gross margins. What your shipping and fulfillment costs are part of your income. Your labor is a share of income. The timing of when you purchase goods, the timing of when your invoices are due, your invoices are due, what the aging is of your accounts receivable, those are all critical. The timing when you hire someone new, timing when you invest in some new advertising or marketing. Take a good look at the aging of your cost of goods and your inventory. How long have they been sitting on the shelf? how quickly are they either turned into the finished product that you can both sell and get shipped successfully to a customer. Make sure that they are not sitting there for too long in your inventory. And then lastly, making sure that your labor costs aren't getting diluted too much, because if you don't evaluate this on a monthly basis, this will creep up on you so quickly and you can find yourself in a very difficult position when it comes to cash. Okay? So let's just talk just a minute about what we need to do from a planning standpoint. There's never a bad time. Matter of fact, it's always a good time to be planning financially with our families, planning for our business. We look back in 2021, you can see just by the scale, some of the states that really were rocked by bankruptcies and business closures back in May of 2021. Some states are less dependent on things that are impacted by inflation, and some businesses have come back much more quickly. We've been very encouraged to see the expansion in the service sector continue. The rebuilding of America, as they call it, through the service sector and the things that people continue to purchase from a service standpoint. Next slide. Just a thought, and we wanted to put this out there. This is something that we've used and many of our businesses have used. And we were excited to start this process a little over 5 years ago. But the entrepreneurial operating system really focuses on 6 different areas of your business. Thinking of your business as the hub, and each one of these is a spoke in your business. The number one thing is vision. Number 2 is the right people in the right seats. Then we have to have accurate information. That data, the things that we measure that matter, have to be given to us accurately and at a very timely standpoint so we can make changes and adjust. Processes. This is a never-ending thing for all of us that are business owners, is to look at our processes. Where are there inefficiencies? Where is there duplication? Where are there things that are causing frustration with people? So the processes that we use have to be in writing, and they have to be followed and have some level of ownership by everybody in the organization. Then there's always issues. If there's anybody out there who's never had an issue in their family or their business or where they work, please let me know, because that would be a first. Those issues just have to be addressed, and they have to be addressed in a way that provides agreement in how we deal with them, and then get them resolved and get those off your issues list. And lastly, when we put these things together, a word that's been used a lot is convergence. We love the word traction, and traction is really bringing it all together. Having that expectation, everybody knows what your monthly and quarterly rocks are that we have to make happen no matter what. Then what our meetings are like. So much time is wasted in business in meetings that are either not necessary, or they are redundant, or they really take away from what the mission and the vision of the company is. So we're going to wrap up this with some questions each of you can be asking in your business. Go back to the beginning. What are your core values? Secondly, what is your core focus? Good to great. Jim Collins talks about the hedgehog effect. What is your hedgehog? What is the thing that you do best? Make sure that you are laser focused. What is your 10-year target? Right now, with everything that's going on, that seems like an eternity down the road, but know what you're working towards and how you're going to get there. What is your marketing strategy? As we all have seen, we're inundated with marketing ideas and communications and things through so many different mediums, then it's overwhelming and frequently we retain almost nothing. So how do we market to our target client? How do we market to the people that need what our business is focused on? And then what's your 3-year picture and how you're going to get there? What's your 1-year plan? What are your current quarterly rocks? What are those things that absolutely have to happen in the next 90 days? And then lastly, what are your issues? Once you know those, identify them and decide how you're going to address them. This is just a very high level of what we would do with our business owners as we think through and help them make the best financial decisions going forward. And as we wrap up, we're going to have we have time for a little bit of question and answer. If you have some questions, please submit those. I believe it's on the bottom of your screen. I know we already have a couple, and we'll start with those. But I want to just end with thanking each of you for taking this hour out of your morning to be with us. I thank you for your loyalty, for your business, and for your encouragement over the last couple of decades. Questions? I can start with one that I've received here recently. And this was a question that was asked to me multiple times, but near and dear to my heart. My oldest daughter asked me about a year ago, "Dad, is this a good time to start a business?" And I said, "Every time's a good time to start a business. What were you thinking?" Well, she has been a esthetician, and she's always worked for somebody. She's worked part-time as she is raising her kids. But after much thought and time and planning, she decided to open up her own business a little over a year ago. And without going into too much detail, she looked at those things that we are talking about now, what the questions that we're asking. She looked at those, she was able to answer those. She got up and running very quickly. She made a very large investment in some both supplies and equipment. And she is so busy right now, she can't do all the work. She is struggling to balance her home life and her business. She's been very profitable, but here in less than 2 years, she's grown her business to the point where she's booked sometimes 3 and 4 weeks out. So that was a question she asked. I go back to what we just went over. Ask those questions, look at those 6 key things in your financials, get some good advice from people that have been there and done that. Talk to your tax professional, talk to your attorney, talk to your financial planner. Any others?
I had one here for Drew on the planning side of things. So as we saw, there's a big difference with the inflation rate, just even going from 3 to 4% throughout retirement. But that's more on the core expenses. You talked about inflation on Social Security. The question is, are there certain areas of the plan that you use different inflation rates for?
Yeah, that's a great question. And we really have the ability, even on basic expenses, we can break those out as finite as we need to, or as the client would like to, and we can assign different inflation rates to all of them. But a few key examples, if we are building a plan and we want to analyze whether or not a client will be in good shape if there's some long-term care needs near the end of their life, we definitely will use a rate of inflation of 4.5%, maybe 5% for long-term care needs, which are already expensive to start with, but historically they've seen inflation rates that eclipse kind of the normal rate of inflation. Education planning, so if you're helping with either your children or your grandchildren's college education, we might even use up to a 6% rate of inflation for that. So, and like I said, we can really divvy it up as in depth as we need to and assign different rates of inflation. So good question, kind of on the whole, we like to use 3%, but we will use higher rates of inflation in areas where we do tend to see higher rates of inflation. And I'm not seeing any questions come in. So I do have one for Evan as well. And before I ask that, and we probably wrap up, I do want to say that we are recording this. And we will be sending this out as well as a follow-up. So if you feel like there's anybody that would benefit from hearing this discussion, please feel free to share this with whomever. So be on the lookout for that probably within the next week or so. But Evan, my question to you is, we talked a lot about the dynamics of interest rates and different returns of different asset classes. It's not to put you on the spot, it's a bit of a nuanced answer, I'm sure, and there's no one perfect answer, but I had mentioned the 10-year treasury rate had gotten all the way up to 3.4%. Now it's come down to 2.85%. We saw energy prices come down, last month, all while the Federal Reserve is raising interest rates. So there's a lot of kind of different variables at play here. While we've also seen kind of the stock market, at least hopefully more permanently, but at least in the short term, find its footing and it has some nice gains the last 6 weeks or so. Maybe you can just speak to, maybe why the stock market's done pretty well here as of late, why interest rates on bonds have come down a little bit, even though we've seen, the Fed continue to hike rates, and all those dynamics at play.
The crystal ball question, maybe we should cut the feed now, Katie, so we don't have this. No, good question, because when it comes to the markets and how the stock market seems to, from time to time, not really reflect what you're seeing in the economy, right? I mean, the inflation rate in March was 8.5. The inflation rate now is 8.5. So you feel like not much has changed. But the market is very forward-looking, right? So typically you see the market start to recover before the economy does, because it's forward-looking based on many different factors, usually 4, 6, 8, 12 months ahead of schedule, you see the market start to recover. And when you think of coming into the year, right, so the market basically peaked out at the top of the year and dropped basically until June. And at that point, inflation hadn't totally ramped up yet in January. I mean, it was starting to ramp up, but not to where it is now. But the market was forward-looking and understanding that the Federal Reserve was going to have to hike rates faster than they had anticipated coming into the year. So with that anticipation of higher interest rates, a slowing economy, that type of stuff, the market was forward-looking and saying, oh man, this is starting to get a little bit dicier than it was coming into the year. And so the reverse of that is now the economy is slowing down. We've seen 2 consecutive quarters of negative growth. Whether that's a recession or not, we'll let the pundits argue about that. But we have seen the economy slow down. And so the market absorbs that and says, well, if the economy is slowing down, maybe the Federal Reserve can accomplish or come close to accomplishing the soft landing, and that they won't have to increase interest rates as quickly as they were anticipating, as we hopefully see inflation pull back and potentially the economy start to recover in 3, 6, 9 months. Because of that, I think that we've kind of made the shift from understanding that there's a lot of uncertainty about where we're at to, hey, there's a little bit better understanding of what policies may be going forward. And when that happens, the markets tend to gain their footing. Maybe some parts of the market was oversold, and things are starting to settling in. And then also you put into the fact that we're coming to a midterm election. I'll end it here because we're at 10 o'clock. Midterm election years historically tend to be pretty choppy, at least until you get to the fall. And most of the gains historically in midterm election years are from September and October on. Okay. We have a better understanding about maybe how the makeup of Congress is going to look. Historically, the stock market likes when there's a split Congress. We might get that. We might know better what policies and spending and tax rates and those types of things might look like going forward. So that's something to watch this fall is how these elections might turn out. How is the economy looking at that point? What are those Fed doing with interest rates? All these things is why we do what we do and try to stay on top of this for the clients and pair that with, hey, how's your portfolio doing in conjunction with your financial plan, making sure that we're on track and there's a lot of moving parts to it, but that's what we're here for. So thanks again to everybody. It's 10:01, ran over by a minute. I knew I was going to do it. But as Drew said, we'll be sending this out. If you have any questions outside of the webinar, just want to shoot us an email, please do. But everybody enjoy their Thursday, and thanks a lot for joining.
Thanks, everyone.
Thank you.